All right, joining us now on the Market Banner podcast, we have Zachary Griffiths. He's a senior macro strategist at Wells Fargo Securities. Zach, what's going on, man? Thank you so much for being with us.
Thanks for having me. Looking forward to it.
Yeah, well, we're here now. We're in it. So look, I gotta start with the news of the hour as a macro strategist, right? You got to be looking at what's happening in these crazy markets right now. GameStop, AMC, Bed Bath and Beyond. What's your read on what's happening in the markets, why it's happening, and what it means, big picture?
Yeah, it's a great question, and it's certainly on everyone's mind. It was the first question asked to Chairman Powell yesterday at the FOMC press conference.
By the homie Gina Smilek.
Yes.
Shout out to Gina.
It's remarkable when you have GameStop coming up in an FOMC press conference. I'm sure that's never happened before.
Right.
But, big picture, I think it's kind of a lot of noise, and unless it really causes major market disruption outside of these single names, I think it's going to be kind of a bit of a fad that eventually blows over. It's hard to say that right now, given how much focus is on it. But for us as macro strategists looking at interest rates and things like that, it's really going to come down to more of what we get from the Fed. And we got an update yesterday, really not much of a change there. And we're looking forward to next week when Treasury releases its coupon auction schedule for the next 3 months. So the Treasury refunding announcement next week on February 3rd. Those are the things that we're really focused on. And while this stuff with GameStop and AMC is certainly getting a lot of attention, it's not really factoring into our broader outlook for interest rates at this point.
So I would push back on that in two ways, and tell me what you think about this. And number one would be this idea that hedge funds are having to sell out of some of their winning names, some of these big tech companies, high-flying tech companies, in order to meet the margin calls because they've lost so much on their short bets against GameStop and the like. And then I think two is that there's a lot more different stocks that these Reddit traders or retail traders, whatever you want to call them, could hit. To me, it feels like it's like a locust phenomenon. They're spotting specific stocks and there's a profile for them, right? A lot of short interest, low prices, not a lot of, general interest in them. And then they just kind of swarm. And there's, I think, a number of different ways that this phenomenon could play itself out where it doesn't end with just these names that we're looking at right now, where this just continues to happen over and over and over.
Yeah, that's an interesting point. And, for us looking at the rates outlook, I guess I kind of tie it back into how it impacts markets more broadly. And if you think about what we've seen over the past couple of days, you have seen a bit of a risk-off shift, and that's something that we're frankly not used to over the past 6 to 9 months. You really haven't seen any major pullbacks in the equity markets. And when we look at U.S. Treasury yields and how they've responded to equity prices, the betas have fallen a little bit. So I guess, I hear you, and I think perhaps this could be a phenomenon going forward. But until we do see these widespread margin calls where it causes a bigger risk-off shift, whether it be hedge funds having to sell stocks and go into bonds or just a big risk-off move caused by the uncertainty of all this, until we see that on a more widespread manner, it's not something that we're going to be focused on, again, from what's happening with U.S. yields and how we see things progressing in the economy and our macro view.
I have a random question. I mean, sorry for not knowing this already, but how did the GameStop or the Reddit people know who was leveraged in what in terms of GameStop and these stocks? Is that public information? I didn't know that was public information.
It is public information, and this is something that I've learned over the past 24 hours, more so out of curiosity than anything else. But some of these big hedge funds, they disclose their positions in different options, and you can see who owns what inputs. And there are some hedge funds out there with some rather large positions, which obviously has gotten out there into the media, and this story has latched onto it. But it is public information. I guess it's just reported with a pretty significant lag. So to get updated information on what's happened over the past week or so, that's not going to be out there.
Okay. Do they have to report that by law, or it's just if they want to?
I think there are reporting requirements around it, and I don't know if that has to do with the size of the position or the type of company that's taking the position, but that's also pretty well outside of my wheelhouse too.
For sure.
Okay. Yeah, Zachary, so I want to go back to something you talked about, and you talking about the Fed, right? I think the Fed is really the only thing to talk about right now if you're an investor. If you're talking about anything else, you're kind of missing the point. Fed Chair Jerome Powell yesterday kind of really came out stronger than I think I've ever heard him before to say, like, it's not us. The asset bubble's not us. Income inequality, wealth inequality, not us. Stock prices going up, not us. The commodity boom, not us. It's all someone else. What did you make of Mr. Not Us yesterday?
Yeah, that's an interesting point. I think what he tried to...
It was a little bit like Shaggy, you know? It wasn't me.
It wasn't me. You can always count on Dion for the timely pop culture reference.
That was pretty spot on. I got to give you that.
Thank you.
But I think, through all of that and all of the questions he was getting on some of these topics that really don't usually come up in these press conferences, they're focused on two things. It's their dual mandate of maximum employment and stable prices, and you can get into some of these asset bubbles, and the Fed has had a difficult time talking about these in the past without spooking markets. So I think he's really laser focused on the fact that we still have 10 million fewer jobs than prior to the recession. Inflation is well below their 2% target. They recently implemented a new longer-run framework that states they're looking to have inflation average 2% over a period of time, so they're looking to go above that. For an undisclosed period of time, they're kind of keeping it flexible, but also focus on shortfalls from maximum employment as opposed to deviation. So everything that they've said and everything that he said yesterday really sets the bar extremely high for any policy tightening at any point in the future. And I think he really tried to hit on that, especially with the talk of possibly tapering asset purchases that's come up by a few Fed presidents over the past couple of weeks. He really talked down the possibility of that. And I think, again, the focus is on until we have these jobs back and until we get inflation up above our target for a sustainable period of time, and we're going to be here buying assets at this $120 billion per month pace, and the policy rate is going to remain at the zero lower bound.
Yeah. Given that, though, I mean, what does that tell you as a strategist? I mean, does that mean it's definitely time to go long or longer U.S. equities, or what do you make of that stance?
I think broadly with an accommodative Fed and also an accommodative fiscal stance, since we did just get a $900 billion package at the end of December, and we could get another one over the next couple months as the Biden administration is coming in pretty aggressive with rhetoric around more fiscal support. I think that is beneficial to markets broadly, and when we think about what it means for the rates market, with the policy rate very low, we think the front end remains anchored. But as we get through some of the worst of the spike in COVID cases and as vaccines hopefully start to roll out more, you have economic growth and inflation picking up, and I think that that's going to push the back end of the curve higher, while at the same time the fiscal side and you have all this borrowing by Treasury is going to push long-end yields higher, as they've really relied very heavily on the back end of the curve to finance the debt that they raised so far in 2020. And we expect them to do the same with any additional debt they need to raise in response to fiscal stimulus in 2021 as well. So we think the curve is going to continue steepening, and it's really driven by the back end rates continuing to rise. And I think in a best case scenario where you have the vaccine rollout pick up and COVID cases start to come down, you could see the 10-year yield hit 150 by the middle of this year. That's really the upper end of our range.
Ooh.
And the lower end, I think, is probably a little bit more realistic, just given what we've seen with the vaccine rollout so far, and the low end of our range there is 130. So it sounds like a big move, just given what the world has looked like since COVID, but in grander historical terms, it's not a high yield at all historically, and the move higher over that time frame is not particularly bad.
So you don't see the chance for the 10-year to really drop materially below where it is right now? Because right now it's at about 1%.
That's right, and that's not our base case outlook. And I think if you get a scenario where COVID cases start to rise, the vaccine rollout remains slow, or even there's additional hiccups in the vaccine rollout so that COVID is a bigger problem for longer than perhaps people are expecting, I think that could send yields lower than where we are now. But I think the key part is if you have those developments and the fiscal response is slow or not at all, then I think that's the kind of recipe for lower yields and really it'd be driven by a big risk-off shift as you kind of shift out expectations for when the economy could reopen again, when all of this excess saving that's happened over the past 9 months could start to be deployed in the service economy and things like that. So that's kind of the scenario where yields would fall. And again, I think it's certainly not impossible, and I think it's hard to say anything's impossible after what we've seen for the past 12 months, but that's not our base case scenario right now. We do think yields should rise. It's really more of to what magnitude do they rise.
Gotcha. Dan, you look like you want to jump in.
No, I'm just really, I still can't make heads or tails of what's going on still, because to me, the market was at all-time high, last year when it seemed like COVID was really just completely out of control. And now the markets were down a lot yesterday. I haven't checked today when, to me at least, it seems like there's more of an end in sight with the virus, meaning, the cases have come back down. The virus rollout, the vaccine rollout, it is going to happen when, who knows, but it seems like hopefully it's going to happen sooner rather than later. So I just think everything's out of whack, to me at least. I don't know.
Yeah, that's certainly a fair point, and it's been tough to track markets and market relationships over the past year that have held historically, whether it be how treasury yields move with equities or the dollar with equities, things like that. There's been a pretty substantial shift, and again, you have, a sharp recession last year, but markets were back to all-time highs in very short order. And again, I think some of that comes down to the fact that the Fed had a playbook to address a crisis this time. They pretty much took everything they did in the wake of the 2008-2009 financial crisis over a period of several years as far as stimulus goes, and did it in the course of several weeks. So the recovery's been sharp because the monetary and even the fiscal response has been very sharp. But from here, it's going to come down to whether or not they can keep pace with the amount of support the economy needs based on how the public health situation evolves.
So, Zach, I want to ask you about that because you've I think been talking a good bit about this stimulus proposal from President Biden, $1.9 trillion, that just being another of these down payments on what's to come. How much stimulus could we get? And I guess I just wonder, is there a point at which folks start to worry? We're hitting we're over 27 trillion on the national deficit right now. We're on national debt, not deficit. We're definitely going to get to 30 in pretty short order. So I wonder, one, how much stimulus you're expecting realistically, and two, is there a point at which the market starts to get worried? Because your 10-year prediction suggests that the market absorbs that with no problem.
Yeah, those are great questions. And to start with our expectations for fiscal stimulus, the House view at Wells is that we do get a package in the first half of March, but it's probably closer to the size of the one that we got at the end of December, so call it $900 billion. We think the $1.9 trillion proposal by the Biden administration is really just a starting point for negotiations. They put a lot of different things in there, like the $15 minimum wage that is probably more of a bargaining chip than anything else. They take that out, and that's a concession and a move toward really a compromise, because while they did take the Senate with it's a 50-50 split with Vice President Harris casting the deciding vote, it's a very slim majority. And they still need to bring over 10 Republicans and have every Democrat on board with this package. So it's no small feat. And if you think about the negotiations around the last package, you had President Trump in office, a Republican who's saying we need all this stimulus, and it took a long time for Senate Republicans to rally around him. We think they're going to have a much more difficult time rallying around President Biden, who represents the other side of the aisle.
So 900 billion. But like I said, is there then a worry about where we go in terms of like the debt, or is that all copacetic?
I don't know if it's all copacetic long term, but right now the focus is on simply getting people back to work, getting the economy back on track. And I think you've heard it from every form of policymaker that it is something we will have to deal with down the road, but now is not the time to worry about it. And I don't think, unfortunately, or right or wrong, $900 billion on top of 20 plus trillion that's already out there.
Right. Yeah. At that point, what is it?
If it helps,
what's 900 billion? Right?
If it helps get people back to work, the economy back on track, and us kind of on the other side of this recession or slow growth period, now that we're emerging from the recession, as long as if it makes that trip shorter, then I think that's what needs to happen right now, and it'll need to be addressed in the future. And you go back to,
All right.
this is kind of ancient history at this point, but after World War II, you had very deeply negative real rates, and real rates in the U.S. are negative now, so that kind of helps
Are negative now, yeah.
get through the debt. And I don't think we're going to hit the negative 14% levels on real rates that we saw in the 1940s. But if you do have negative real yields, that kind of makes this deficit spending hurt just a little bit less than
Right.
if real rates were in positive territory.